I guess the first question is to what extent people are starting to draw the conclusion that the rapid growth in Disney Plus subscribers was pandemic related rather than long-term, sustainable, structural related.
I mean, I think today's the reaction of the stock seems a little overdone. It was the sub numbers were just over 1 million off of our estimates. Estimates have been all over the street. As we all just heard, Bob Chapek said it was in line with their estimates, which of course we don't know. Disney doesn't guide to sub numbers, so they're at 103, 104 million subs in just over a year. They must have reiterated 4 or 5 times last night on their call that they still maintain their guidance of 230 to 260 million subs by fiscal year in 24, 5 years after launch. And we're right there. Our projection is 250 million. I just think, it's a slight miss versus expectations, but it's enormous growth. And this is before they really have all of their product flowing. Remember, they couldn't produce what they planned to because of COVID.
So to what extent, therefore, do you think that the share price pullback is overdone? But I guess compared to the fact that it is fairly richly valued and not all of the business lines are growing as fast as the Disney Plus subscribers are.
But that's the key to the story. If we all believe the economy is, you just had a piece on inflation, the economy is heating up. What better way is there to play? Who better to invest in than Disney as the economy reopens? So pre-COVID, 50% of operating income came from the theme parks. Demand for travel and demand for Disney's parks specifically is incredibly strong. One of the things management said was that it's above 2019 levels, and that's not including international visitors who still can't come. So with capacity restrictions easing, so instead of 6 feet distance, it's 3 feet, and because they're putting new technology in the park, they can get more people in and out more efficiently. Their costs are coming down. So the bottom line is theme parks are just beginning to recover, and we will see that over the next quarters and years. And that's where the surprise will be. There's enormous leverage in the theme park business. It's largely fixed costs. And when demand is strong, which it probably will be for the foreseeable future, we'll see really strong growth. So historically, whenever there's been like a recession or some pullback in attendance, whether it was 9/11 or something, or the economy, there's a 5-year, once the parks pick up, there's a 5-year growth curve.
Do you think that's already in the stock, Jess? I know they were very happy about the fact that you don't have to wear masks at Walt Disney World in Orlando in 95-degree heat, and that could mean more capacity inside the parks ultimately. But do you think that recovery story of parks is already in the price?
I don't think people remember. Honestly, I don't think people remember how much they can surprise on the upside. There is so much leverage in this business. So they can go from under $1 billion this year to $6 billion plus in operating income in a year. And there's a 5-year growth curve. I think that the demand is really, let me give you another example. Their cruise ships obviously are not running right now, but they're going to start selling tickets for a cruise that's like a staycation. People can't get off the boat. And the demand is crazy. But that's just one of their businesses. It's a big one, which is why, of course, it's important to talk about. But all of their other businesses are just opening up. So television production, film production, and distribution, movie theaters are opening up. Broadway, Disney is a very big producer of Broadway. All of these things will be very, very positive for Disney stock. And we're talking about Disney Plus like it's a disappointment. They missed a number in one quarter. Disney Plus is a massive success. And if you put it in the scheme of where direct-to-consumer will be, I think most people in the world would think that the primary bundle will be Netflix, Amazon, Disney Plus, and the other companies you can trade around, churn in and churn out of. This is a really good story. And the Hulu and ESPN Plus numbers were also very strong.
Shepard Smith here. Thanks for watching CNBC on YouTube.